You know I'm a stranger, a willing.
Hello, I'm glad that you decided to click on this video. I want to tell you something. Do you believe that you have to get into a 30-year mortgage? Do you believe that you have to stay in a home for 30 years and it takes that long to pay it off? I hope not, because that's not true. Just like me and my parents, grandparents, I thought, okay, I got a mortgage. I have acquired the American dream. I'm a homeowner. No, you are the homeowner of the bank's home. You're not a homeowner. They have the deed. You're just paying them basically rent. But then I discovered a couple of years ago that you may take out a 30-year mortgage, but your ultimate goal is not to stay in that 30-year mortgage. Do you realize banks are counting on you taking out that mortgage, and they probably figure you're going to get the 7-year itch, which means that within 7 years, 5 to 7 years, you're going to move out of it anyway, which means all the money you paid to them in interest, they've capitalized on it. You haven't really begun to hit the principal at all. And on top of that, you're going to go get a brand new house and you're going to start that whole entire 30-year mortgage debt cycle all over again. What if I told you that you can not only pay that house off, but that you can pay it off in record time, way ahead of the 30-year mortgage? I want you to know something. There's something called a first position HELOC. We've heard about HELOCs and all. Those are typically in the second position, which means when it comes to your home, those that have the first claim can take the home in the event that you would actually default on your debt. We're not talking about that case here. We're talking about you being positive and paying your first position HELOC and owning the property. Well, it's going to take some little convincing to get you to get there. But anyway, let's say you have a home. Let's say the home is, you owe $400,000 on the home, but the home is worth $600,000. You have some options here. You're sitting on $200,000 in equity. You can go to your local credit union. I deal with credit unions. They're nonprofits. They work for their members, and say, hey, listen, I'd like to take out a first position HELOC. In that, you're telling them that I want to eliminate my primary mortgage and do away with that. I'm going to use that first position HELOC to pay my mortgage completely off. Okay, I'll give you a little bit more details. First position lien, which means that if your house, once again, you owe $400,000 on it, but the house is worth $600,000, the bank will give you up to 90% loan to value. Let's take $600,000 times it by 90. You're at $540,000. But remember, I told you that you only owe $400,000. That's where the first position lien is going to come in. You're going to go ahead and you have up to $540,000. They're going to give you automatically. You're going to take that $400,000 out of that $540,000, and you're going to pay your mortgage completely off. You're eliminating your mortgage. Now you are mortgage free. You may say, well, I still have a debt. Right. You have to pay the line of credit, which is your first position HELOC, off. But the difference with the first position HELOC is, number one, you're just going to pay on your daily average, which means if you have a daily average of $400,000, you're only going to pay on that. But when you make those payments every single month, your payment is going to go down. Now with the mortgage, your payments are totally set. You're going to pay the same payments every single month. But did you forget, for about the first 7-8 years, you're paying nothing but interest and you're giving that to the bank? With the first position HELOC, not only do you own the home, but as you pay down that line of credit, your first position, your payments will go down every single month. So I'm proposing that you throw all of your income in there, thereby eliminating the payments, making it cheaper, because remember, they're going off of what they call your daily average. If your daily average is, let's say, $400,000, you make about $12,000 a month. You're going to inject all of that into that first position HELOC. You're going to live off of that. You're going to pay all of your bills off of that. Let's say your expenses are $6,000. You've gone from $400,000 all the way down to $394,000 in 1 month. Can you see what I'm doing here? You're paying that down. So your payment is going to go down every single month. Another thing that we fail to think about with a first position HELOC, you can actually withdraw funds from that and deposit funds into it. Unlike a mortgage, you can't take anything out. All you're doing is putting your money in that mortgage payment every single month. So when you have that first position, you can take money out, pay it back, take money out, pay it back. Let's see, there's an emergency that comes up. Yes, you can go ahead and you can pull money out of your first position HELOC as you need it. But the goal here is to continue to throw all of your income in there and you're going to pay off your line of credit. Once again, as I told you, let's say if you had $12,000 in income, but once again, put your own numbers in there. You know what your income is. You know what your expenses are. Put your numbers in there. If you had $12,000 in income, you had $6,000 in expenses, you can actually extract $6,000 a month directly towards that principal. Remember, it's off a daily average, so as you pay it down, your payment's going to decrease every single month. With a mortgage, not such. You're paying that mortgage every single month, same payment all the time. And also, you are also paying only on the interest when you have that first position HELOC. That's all you're paying for. So take a look. I posted information about a first position HELOC and also a mortgage. Which one would you want? I'm going to lean towards that first position HELOC because I know one thing is that I'm done with my mortgage. My mortgage is paid off. I'm working on paying off that line of credit. But with the line of credit, as I said, you can live off of that and you can pick and pull from that. Rich people, you guys, they don't take out mortgages because they know that mortgages are stuck and the bank is going to win. They take out lines of credit and they pay those lines of credits down because they know that as they're paying it down, their payment's going to decrease every single month. Let's say you're living on, you're approaching retirement, and you know that when it comes to a mortgage, that mortgage is typically going to sit there and it's going to be requiring you to pay it every single month, the same payment. Because you're in line of credit, can you imagine your payments are going down? And like I said, this person here, they're bringing home $12,000 a month. They are actually, the expenses are $6,000 a month. They can pay that mortgage off in 7.5 years, you guys. That beats a 30-year mortgage. Let's say if you're 50 years old, you know your goal is to retire in the next, maybe the next 10 years. You can have that mortgage paid off by the time you're 57, nearly 58 years old. You aren't straggling and wondering, how am I going to pay my mortgage? You own the home.